Perfect. All right. Well, I'm gonna jump right in on this, and we're recording this. So if you want to come back and take a look at this, we'll distribute slides and recordings after this. But we are living in some interesting times. Obviously, one of the big factors that is dominating grain markets and markets in general has been Ukraine, Russia. So I will talk a little bit about crop insurance and ARC PLC, but I felt it was necessary to jump in and kind of give an overview of some of the things that are happening or potentially happening, because this is a very fluid situation with Ukraine, Russia, as it relates to global crop markets. And so when we look at this, the first one that I want to point out is obviously wheat. We've seen an explosion in wheat prices, 166.5 cents in the past 7 days. This is as of close last night. So we've seen tremendous rise in price, and there's some reasons behind that we'll end up getting into. The other thing that I do want to highlight from this price chart, and it's just a futures price, is just the volatility that we've seen, some massive daily swings, because there is a lot of information out there and high degree of uncertainty as what the long-term ramifications are from this conflict. Obviously, both Russia and Ukraine are substantial players in wheat markets. When we look at corn, very similar thing. Last 3 days, we've had a 45-cent trading range. That's a big trading range for a 3-day interval. And again, you see that volatility that has been created in these markets. This does present challenges, but it also presents some opportunities. And we'll talk a little bit about some of the pricing mechanisms that might be effective in these types of circumstances. When we look at soybeans is a little bit more challenging one. There's a few reasons that soybeans, because both Russia and Ukraine are not major soybean producers. Ukraine is a major producer of sunflowers and sunflower oil, so that does have implications for soybeans. But I think a lot of what's going on in soybeans is concerns about global economic instability and what potentially China might end up doing, or what their reaction. They have been very silent on this conflict, and that is somewhat concerning since they are the dominant buyer. But again, when you look at this, the key takeaway from this presentation is look at the volatility that we've seen, a $1.52 trading range in the last 4 days. And I will point out, if you look at options, and I think options are a super powerful tool under these circumstances, and at the money put is $1.20. When you look at $1.52 worth of movement in 4 days, there's incredible value there in terms of establishing a futures price floor. Now, I'm not a huge proponent of keeping options through the duration or until expiration, but I think they can be used effectively, very strategically, when we have these types of very risky and uncertain set of circumstances that are likely to persist for anywhere between the next couple of weeks to, it could go on for several months. So thinking about what tools are available to manage our risk in addition to crop insurance, because crop insurance is a great risk management tool, but we have to always remember that crop insurance is not the same as pricing some of your production. And so when we look at why this conflict is having such a big effect on crop markets, there's a whole bunch of things that are embedded in here. But when we look at the share of global corn exports, Ukraine represents 16% of that market. And when we think about that, it's 1.3 billion bushels of corn that they are exporting on an annual basis. Wheat, when you look at it, it's about 29% between both Russia and Ukraine. So substantial players in global markets, and that's going to have impacts on there. One of the ones that is challenging is there's concerns, obviously, over the logistical disruptions, the damage to infrastructure that can be both short and long-term consequences. But if this conflict continues to end up dragging on for several months, then you run into potentially very severe production disruptions as well, when we think of them harvesting their winter wheat crop, or getting corn planted, or getting sunflowers or barley planted. There's some substantial concerns that we end up having in terms of the production side. And so I'll talk a little bit about that as well. The other one that is kind of another major concern, we've all seen the extreme increase in fertilizer prices this year compared to last year. Well, one of the challenges with the circumstances right now is we do have Russia as a major contributor to global fertilizer production. And so when we look at things like ammonia, where Russia's contributing 11% of production, When we look at things like potash at 19%, Belarus at 17%, Russia at 14% of urea. This is not going to help global fertilizer prices and logistics. And so again, this is something that the longer this goes on, the bigger disruptions we're going to end up seeing, not just on the output side or the commodity side, but on the input side, which is a real challenge. I threw these maps in here not because they particularly provide a bunch of information. I'm sure everybody's following the news and seeing where some of these conflicts are occurring. So I just threw this up kind of just for informational purposes, where we look and see where corn production is in Ukraine. And most of it is in kind of the north central part of the country. When we look at wheat, that kind of shifts down into the southern and more to the eastern portion of the country. And so again, this is more just kind of visualizing where some of these production regions are and how disruptions in those regions could adversely affect production, and then also obviously damage to infrastructure and logistical capabilities. Most of the major grain companies have shut down their ports in the Black Sea region for obvious reasons, and again, that's just going to continue to affect global trade. There are reserves out there for corn and to a lesser extent wheat. But again, we're looking at having dramatic price effects on this potentially, and for sure having volatility moving forward. So when we look at kind of some of the implications of the Russia-Ukraine conflict, it is super unpredictable right now. Everything's changing on a minute by minute basis, and you see that in the volatility in futures markets. The logistical and production disruptions are just largely unknown. We know that both of these countries are major players in corn and wheat, and then Russia's major player in fertilizer, but we just don't know what the extent of these disruptions, how long, what the duration is going to be. Is it going to affect multiple production seasons? It's just going to be incredibly challenging. The other one that obviously has implications is higher energy prices. You could do an entire presentation on the impact on energy prices. But when we think of it just in general, in terms of our economy, energy prices are a strong influencer of inflation. We're already having issues with inflation. So this can be something that continue to provide some major issues. The other one that we have seen is a strengthening of the US dollar. Obviously, when we strengthen our dollar, it makes our imports more expensive relative to other areas of the world. So again, that's something where it's probably a shorter term phenomenon, but it's something to keep an eye on. The big one is global economic uncertainty. Anytime you have this type of large scale disruption, it's really difficult to predict what the consequences are going to be in terms of trade flows and economic activity. Embedded in that as well is obviously we're in a new set of circumstances in terms of the way that people wage wars, and cyber attacks is a concern, and agriculture is not immune to that. And we've seen that in the last couple of years, where we have seen cyber attacks, and this is something that is concerning, could disrupt logistics, could end up really having an issue on our agriculture supply chains if that route is taken. I'm not predicting that. I'm just saying that it's something that's in the background that should be a major concern to a lot of our large agricultural companies. And then, the one that's been eerily silent on a lot of this conflict has been China. And so that makes you concerned for numerous reasons. One, are they going to support Russia and end up purchasing some of their goods, take some of the pressure that is being exerted through sanctions off them? And then, the other one is, does this embolden them to end up making a move against Taiwan? I'm not a specialist on that. It's just, something that is embedded in some of the concerns that are floated around out there in markets. And obviously, if they did end up doing something, it would be dramatic, not just for, global markets, but when you think of things like soybeans and markets where we trade a lot to China, it could be dramatic what the impact could be if something happened there. So in terms of what to do, I like where some of these prices are. I think there's commodities that you can be more aggressive in pricing than others. Wheat obviously is one of those where we've seen it, almost at $10 this morning. I'd be a bigger proponent of pricing a little bit more depending on where you think your wheat crop is and where pricings end up being. Soybeans and corn, I'm not at the point where I would get much more aggressive than having 25% priced. And a lot of that's going to depend on what you have in terms of storage, how you normally end up marketing the crop. There still is some upside in this market potentially. So again, I don't necessarily think getting too aggressive at this time of year, particularly when we've got some strong crop insurance guarantees to set some revenue floors. I am a big proponent, if we do see these prices to continue to go up, is to start establishing downside protection on the 2020 crop. I'm a huge proponent of using put and call options in these circumstances because it gives you flexibility by establishing a price floor or taking reownership of a crop if you do price it, to make sure that you do have the potential to participate in an upward price move if things really do get crazy in markets to the upside. So again, taking away that downside risk while allowing upside participation, I think is huge under these circumstances. I am going to jump into crop insurance because we finalized our crop insurance prices on Monday, and it's a really important component to our safety net. So for those that haven't seen it, our crop insurance prices were set at the end of February there. Corn's $5.90, cotton $1.03, soybeans $14.33, and wheat again as set in the fall at $7.14. But you can see those volatility factors. So there's two key takeaways here. One, I'm a huge proponent of crop insurance. I think it's an absolute necessity when you're growing crops. I'm not a big proponent of pulling back on coverage this year. I think there's some real benefits to end up getting a real solid revenue guarantee under this crop. So I did a quick example for corn. If you have 185 bushels per acre at $5.90 and a 80% buy-up coverage, an $873 revenue guarantee is what you'd be looking at. And again, when we compare that to our cost of production, do we have the ability to end up covering off a big chunk of our increased input costs under this environment? I think a lot of producers will have that ability. The one that is going to give people some sticker shock is going to be the premiums. They're going to be substantially more expensive. Premiums are a function of prices and then volatility that occurs during the price determination period. So unfortunately, we're going to have some really expensive premiums when you sit down with your crop insurance agents or talk with crop insurance agents. But in my opinion, under these volatile circumstances, it's going to be worth it. You do have a whole host of other crop insurance decisions to be made, ranging from unit structure, buy-up coverage, area or companion policies. I'm going to talk a little bit about SEO and ECO. And then the other one that I will say, because this is always a debate, is should you have the revenue protection insurance or revenue protection with the harvest price exclusion? I'm actually a big proponent of actually keeping revenue, that second roll of the dice in the fall. I'm not a huge fan of having the harvest price exclusion, because I think conceptually you can look at this and think of this revenue product as operating kind of like a put and a call. It's establishing a price floor in the spring, but it's giving you a second roll of the dice in the fall if we see things really explode on the marketing side of things. So again, the take home message is producers, they need to individually tailor their coverage for crop insurance because it's such an important tool. So working with a qualified, knowledgeable crop insurance agent so that you can really get the most out of your crop insurance protection is absolutely essential. It's really difficult to generalize what should be done, but working through the scenarios now is incredibly important because this is going to be a super expensive crop to plant. And if we have these tools, we need to make sure that we're optimizing them to make sure that we're removing risk. The other big one that's coming up, you have to sign up for ARC or PLC by March 15th. This is I think an easier decision than most years. The big thing with this is there's a very low likelihood that we're going to see big payments out of these programs. I don't anticipate that happening. And again, you do have to sign up, producers have to sign up at their local FSA office. But again, there's not a high likelihood of payments. But if you're thinking about, well, what should I enroll my base acres in? It's important to realize that PLC is price triggered. And so there seems to be a very low probability that we will get below the effective reference prices that I will show. If you are concerned of a complete and utter collapse in grain markets, PLC might still be the option. But I see a lot of people looking more kind of towards ARC. And a lot of that is because of price and yield. It is a shallow loss program, so you could end up getting some benefit from the yield. The one that I would caution people on is PLC. If you are looking to end up buying supplemental coverage, you do have to be in PLC, and supplemental coverage is an insurance product, so you do have to pay a premium for it, but it does give you more coverage and has a higher likelihood of payout than if you went in Arc County. So again, one of the key questions that I think producers have to ask themselves is, are you going to participate in supplemental coverage? If you are not, then Arc is the way to go. If you are, then you have to be in PLC. So that's one of the first questions I think people need to ask themselves. There is another product, and it's not contingent on the sign up in these acres of ECO. I'll talk a little bit about that. That's kind of the way I look at it, is if you are looking at participating in supplemental coverage, you have to be in PLC. If you are not going to participate in that program, then ARC is clearly the one that's going to give you a little bit better set of circumstances. The other one is, are you considering ARC individual? I'll kind of go through and give some of the I guess the things that you'd look for if you are going to end up participating in that. And then the big one is, what does the crystal ball say about prices? We have to remember that this sign up is for the 2022-2023 marketing year, so we're 19 months away. There's a ton that can change in that time period, but where we are in terms of price, it would take a dramatic change of where we've been headed to get anywhere near some of these reference prices. So when we look at these effective reference prices for 2022, we're looking at $5.50 for wheat, $3.70 for corn, $8.40 for soybeans, seed cotton at 0.367, and then grain sorghum at $3.95. We look at the 2023 harvest futures. Again, that isn't even this December for corn. That's the December after that. There's a lot of air between the reference price and the harvest futures price. Now, obviously, things can change dramatically, but I really don't see a high likelihood of seeing PLC payouts under this. This is where I think you can get some leverage, particularly for SCO. This isn't the greatest diagram. I pulled this from Iowa State. I don't like it for one primary reason. It does illustrate the point in how these area protection products work, but it's really important to note that this is a different unit that you're insuring than these two. These are based on county or area yields. These are based on your individual units on the farm. So this should really be kind of offset a little bit, but you can see you can end up getting some decent coverage when we look at if you want to really bump up that crop insurance protection, because again, you're still getting those high prices that are embedded in these products. So just to give a real quick understanding of where supplemental coverage insurance or how it works, it sits on top of the multi-peril crop insurance product. And so what it does is it'll cover up to about an 11% band if you go 75 to 86%. And what you do is you take that expected crop value. So again, that price is embedded in there, those high prices, and multiply it by 11%, and then it'll give you your guarantee. And then that's multiplied by the 11% to get your dollars per acre that would potentially sit up on top of that. Now, the thing that's important to realize on this product is it doesn't matter what happens on your farm. It only matters what happens with the county yield. So again, you want to have those conversations with your crop insurance provider. When you look at enhanced coverage option, again, this is just another one that's sitting on top of the SCO coverage, which is on top of the multi-peril coverage. And so again, this is just a way that you can really layer some additional protection on top. It works very similar to how SCO works, but it takes you all the way up to potentially 95%. And so when you're looking at this, one of the key questions that your crop insurance agent should be looking at is, how well do your yields correlate with the county average? That's going to give you an indication of what the protection is. Now, you're always subject to anomalies where you could experience a loss, but the county doesn't. You wouldn't necessarily see a trigger on some of these payments. So again, just tools in the toolbox to consider for producers to try and take some of the risk off the table. I did mention ARC individual coverage. Again, low likelihood of payout given where we're at. But it is more complex than the county version. It pays on 65% of the base acres. So there's kind of 2 points that I want to make here where you may be interested in ARC individual coverage. The first one is if production is highly variable from year to year on your individual farms, that may end up warrant a good look at ARC individual, because you're looking at average revenue across multiple commodities. And then the second one is if your ARC individual or your farms have a benchmark yield that is much higher than the county average, and PLC payment yield for farming. We're talking somewhere around 30%. And so again, I'm not saying that would 100% move you to ARC individual coverage if you're interested, but it is a consideration that is worth investigating as you look to sign up for these programs. When we look at prices, obviously prices are all over the place right now. We've seen extreme volatility. What I kind of been looking at is the average price of the December futures contract and then what that range is. So if you think about this kind of conceptually, when we go back to 2021, from the maximum of the December contract from January to when that contract expired, the range of prices was $2.06. And so when we look at where we're at right now, so far we've averaged 578. We're above that right now, obviously, but since January 1, we've averaged 578 on the December corn futures contract. So how can we factor that into some of our pricing expectations in 2022? Obviously, we've had a massive amount of volatility. I don't think anybody that I've spoken with has said that we're going to have less volatility in 2022 than 2021. But we'll use the 2021 volatility of 2.06 or $2.06 to end up giving kind of a bit of a price range to start the 2022 season. And so when we look at prices, we start with that average where we're at, and then we say, okay, well, what happens if half of that volatility from last year or range from last year is to the top, half of it is to the bottom? It gives you a price range of 474 to 681. If we say that all of it's to the upside, that gives us a 784 target with a downside of 371. When I look at this, my big thing that I tell producers, I'm not as concerned with these. If we can get these prices, that's great. But can we make sure that we at least mitigate the downside? Crop insurance will do some of that, but I think we do need to end up thinking about other pricing mechanisms that we can utilize to strategically remove price risk at key points in the year. When we look at soybeans, again, similar set of circumstances, 1281. But if you look what we've already seen in terms of volatility, oh, I cut that off. What we will end up seeing is right now we've averaged 1375 in 2020 for the November 2022 contract since January 1st. We take that range of 348 and you add it to the top or in the bottom, 1722. And again, this is on the November contract, so we have to factor that in. But it gives you an expanded range of 1027 to 1722 with kind of a target range in there of 1548 to 1201. So again, when we look at this, we are going to continue to see a lot of volatility. I think the big take-home message is make sure that we're managing the downside of this, because there's profit on the table for a lot of people. Some of these are going to be expensive tools. So if you think of this in terms of put options, for example, the premiums are going to be higher, but I would look at it in terms of relative percentage terms of the value of the underlying commodity. When you see that, you will see some value in some of these strategies for sure. We look at wheat. Obviously wheat's been the one that's been the most volatile the last couple of weeks here. But when we look at where we're at, the current futures price that I pulled this morning, we're at 996 versus a crop insurance price of 714. And so when we think about this, a put option this morning at 950 for 75 cents can get you an 875 futures floor. That's pretty good value based on what we've seen in terms of volatility the last 7 days to a week. When we look at what we've seen in terms of a price range, we've already seen a price range of 269. Now, obviously, this goes from October to July, and we still have a few months left. But we've seen an expanded price range, increased volatility. I think we will continue to see this across our commodities. So this is kind of a good example of, we have that base price. This was established in the fall for our winter wheat. What can we do during the production year when we see these high prices? You could see more upside to this, but I do like getting a floor price underneath this at 875. And so how this can kind of be looked at is, if we look at corn and soybean prices as we move through the summer, if this opportunity presents itself, I think we need to end up seriously considering protecting that. So when we look at this, we don't really have a great idea on the top side. We've actually already exceeded that range based on 2021. If we took that range of $1.88 and added it to the upside, we bumped above that today. So we're in real uncharted, uncertain territory here. And so again, the more that we can bump up where that floor is relative to our price expectation, I think we can really take a look at that.